Yeah, and we can get right into it. I've got some slides for today. If we want to flip over to those. Interest rates, definitely an interesting story. As of late, interest rates are falling. What does that mean for the U.S. dollar? And this is interesting, I thought, because interest rates and U.S. dollar, the relationship in theory should be pretty straightforward. When interest rates are higher, especially short-term overnight interest rates, you're getting more yield for holding U.S. dollars. So there should be a correlation in theory, very strong with who would want to hold U.S. dollars and when. But what we've seen recently in the interest rate market, here I've got the 10-year yield and the 2-year yield. We're seeing from those January highs, we're seeing a big sell-off, a big move lower, especially in that 10-year yield, more pronounced than that 2-year yield. So when you think about when the Fed is going to cut 1 or 2 times, maybe that's not as interesting, and that's closer to the 2-year yield there. But the long-term, perhaps inflation expectations, and longer-term interest rates definitely taking a hit. But it could also be because what was interesting in January is even at those high yields, people weren't really buying bonds, were they?
Right.
And so maybe now the safe haven play with recession fears, people are actually engaging with these bond markets again when they haven't in recent months.
Yeah, I think when you see true two-sided equity risk, which we're seeing a little bit of, but NVIDIA will save us all. Yeah, I think 4.5% wasn't that interesting.
Right.
Now all of a sudden it is. And I think you're actually, because you would say, well, part of the reason the economy is slowing down is we're seeing stickier inflation, we're seeing this. That should cause yields to go higher. There's always more than one thing driving it, and that idea of, okay, if some of the equity exposure is being peeled off, where's a natural place to park it? And it's absolutely in treasuries. So that could be fueling a little bit of, okay, 4.5% isn't that exciting if every day stocks are printing new lifetime highs.
Yeah.
And whether you're a fund manager who's got to, again, hold on to your fund and explain to your customers why you're not participating, or you're an individual looking at everyone around you participating in this rally and thinking every new high is too high to buy, that idea of missing out makes this alternative a little bit more challenging. Now, a little bit of that is changing with this.
Yeah, and it'll be especially interesting to see if any of this 10-year yield decline sticks. We had that consumer number yesterday. That's where it'll really play through when we've been in this environment of high yield savings. If that starts to come down, maybe it is more of a snowball effect than we've seen so far. But wanted to take this price action, relate it to U.S. dollar.
Right.
Here we're looking at the U.S. dollar 3-month correlations to U.S. rates across the yield curve. We've got the 10-year, the 2-year, and the 20-plus year, the longer-term interest rates against each of the major U.S. dollar currencies. And we're seeing some interesting trends. The difference between red and green here is mainly all in part due to which side of the currency pair U.S. dollars on.
Right.
So here I'm just looking at the magnitude because for the Australian dollar, euro, and pound piece, the dollar is on the bottom there, whereas for the other three, it's on the top. So that's where we get the red, the positive versus negative correlation. But we're seeing the greatest magnitude of correlation with the traditional flight to quality assets, currencies, Swiss franc and Japanese yen. And what was interesting to me, we're seeing a stronger correlation with longer term interest rates than short term. Because when you think about it, theoretically, this stuff should move with the Fed funds, the 2-year.
And the equivalent, right. And I think you make a great point. So they're all positively correlated. In other words, and it's a good explanation that depending on where the base and quote currency is, what side of the equation the dollar is on. So the negative number is actually a positive correlation between the currency, the dollar piece, and yields, which again, it's the degree of correlation. And you're right, the safe haven currencies, whether that be Swiss or yen, have a much more direct impact to 10 years.
Yeah, especially that dollar yen 0.65. That's a pretty strong correlation. Do you make anything of the correlation within rates here? Is that, to me, it was interesting. You're looking at 0.76.
That's low.
Yeah, that's what I thought as well, but
Yes.
I have less of a historical basis.
It's how far back did you go on a 3-month rolling
yeah.
curve? Yeah, that should sit between, again, 78 and 88. So anything when you see the 60s there or the low 70s, that's awfully low. Yeah.
Interesting.
Yeah.
And so taking a look at those, the dollar franc and the dollar yen, we treat them as a popular story is to say they're safe haven assets. But what is the story behind it? Is it when we see some divergence in dollar markets, we see European currencies acting one way against the dollar, and we see the Swiss franc and the yen, which have had a lot of momentum recently. When we see those outperforming relative to US dollar, a lot of times we chalk it up to, oh, well, it's the safe havens catching a bid here. But is it more a story of converging rates?
Yeah.
Because we're
This
seeing
is a
that.
great visual.
We're seeing that we have both of them. We have some uncertainty, but we also have lowering U.S. rates. And when we take a look at here the central bank set rates, we have a big decline in the U.S. With this recent kind of shakeup. Our December expectations are now centered around 2 rate cuts.
Right.
A month ago, we were looking at probably just 1. So now we're back to 2 rate cuts. Japan, completely different story. We have been hiking in Japan, and we're currently sitting at 0.5%, and another hike expected this year. Right now, they're trying to guess when that'll be, maybe Q3, so could be for a while. But there, we're seeing a very direct convergence in rates, and that is, it's been very popular, the dollar yen piece for carry trading. And
Absolutely.
that's exactly where you're seeing this play through, is now there's less appeal for capitalizing on the divergence of interest rates. Historically, if we look back to 2024 at the start of there, it's over a 5% difference. Now we're closing in on 4, maybe 3.75%.
And this is great because, again, we use Japan and the yen and the Swiss franc interchangeably as safe haven currencies. Again, old school, and that was then, this is now. Whatever pit I was closer to, if I saw equities really taking a bath, I'd buy 20 Swiss or 20 yen, whichever was closer, just because I wanted to have a little contracyclical on. This speaks to why that indifference between those two safe havens isn't going to work for you here.
Right.
Because you're seeing a material disconnect in the direction of travel of rates, where the Japanese rates are helping that cause of seeing that yen contribute to more dollar yen selling, where the Swiss component of whether it's not a safe haven or not, the yield differential is moving in the wrong direction for that play to work. So this really is a great, really clean thing of, well, from a safe haven standpoint, Swiss and Japan are interchangeable. Not so much. And this yen, this rate divergence of trajectory. Don't get hung up in the nominal.
Right.
The nominal's given. That's
It's there.
priced in. What is interesting is when the direction of travel or the implied change, that's where we see rates react immediately. Not when the rate change takes place in the
Right.
Bank of Japan. That's already priced in. Markets are efficient. But this is a really good takeaway about what do I want, which currency do I want to use when things are happening, give it a change in rates, or a change in risk. And a really powerful takeaway here around this really makes it very clear as to why the Swiss and the yen aren't interchangeable pieces to be used for rate divergence or safe haven plays.
Exactly, and this graphic would speak to the Swiss franc being the remaining safe haven asset, because you look at their rate path, they're cutting rates at a more aggressive pace than we have in the U.S. They're obviously didn't get as high, only got as high as 1.75%.
But they were down at negative 2.5% at one point. So on a curve, you're absolutely right. But I think this is a natural drag on Swiss, and that frustration of why doesn't Swiss rally? It speaks to a little bit of that longer term play.
And yeah, December expectations. This is for the end of year here. Put it at 0.25%, but their chancellor or whoever's in charge said they would be comfortable at 0 or even negative if necessary. So,
and there's a, I don't want to have to move them, but I'm going to talk them down to see if I get the reaction I want. And it gives you an idea of direction of travel, which is great. Solid takeaway here.
But yeah, just wanted to bring up one final point here. When you're kind of looking at both of these markets, you're looking at the dollars, and you're kind of wondering why, from a fundamental standpoint, each is moving the way they are. An easy check right here would be to check the currency crosses. You're looking at Swiss franc, Japanese yen, and there you have just a direct relationship, and we're seeing a lot more yen strength in 2025 than the Swiss franc. So more of an interest rate hike piece from Japan.
A fantastic walkthrough of the differentials, correlations. The challenge often is, okay, what do I do with that? And it's like, well, you can kind of, here you've got the product, again, you see the changes in rate trajectories. This is one of the great things with FX. You go right, you don't have to build something or have something that has a core, go right to the rate play, which is Swiss yen, and trade it. And that is a powerful way of being able to, your interpretation of, well, the Swiss may cut more, or the yen are overly aggressive in their rate projections. That built into your trading strategy, but the ability to express that in one built product that's scalable in size is great. Fantastic walkthrough by you.
Thank you.
Excellent job as always.
There you have it.
Guys, coming up next, Tom, Tony, and Vanetta. We'll be back with you tomorrow for more Forex Focus at 6:30.